Good evening, everyone. Good evening, Fisdom investors. Good evening to all the viewers out there. Like promised last week, we are back with yet another very interesting episode of the Fisdom Wealthcast with an amazing and interesting guest with us. We have Rahul Singh, who is the CIO Equities for Tata Mutual Fund. So, Rahul, a very warm welcome to the Wealthcast.
Thank you, Nirav, and welcome to everyone.
So Rahul, while we were deciding on this wealthcast and the content, the first things that we decide is what should we name it or what should we title it. And one of the analysts on my team suggested ringing the bells, and he had a very interesting thought behind it. He's like, it's the season of bells, right? So people are looking forward to market opening bells. People are looking forward to the closing bells. Then we have the jingle bells. So why not just ring the bells all around and talk about the key events that mark a significant shift or a change or a movement in certain direction. So I feel this conversation is going to be more about ringing the bells that people want to hear, right? And I feel the most prominent bell that most of us are hearing and talking about is the recent behavior of bellwether indices. Okay, so yesterday, right, just after the UK news came out, that a new mutated version of the virus was found, and a lot of press coverage around it, and a number of other news. Just after that happened, indices tanked severely yesterday. Okay, and today it has already recovered above 50% of what it's lost in a day itself. I've heard investors talk about it in hushes and whispers कि बॉस हो क्या रहा है, चल क्या रहा है, कि एक दिन में बोला मार्केट पूरा फट जाएगा. Yesterday there were WhatsApp forwards about the bloodbath has begun, and suddenly today people are talking about a new sunrise. So what happened? What happened yesterday? What happened today? Is it just normal for things to happen this way? Is it just holiday season, or does it have anything to do with the pandemic that we are in? So, what are your views on such erratic behavior of the Nifty?
No, good question to start with, especially that you talked about the bells, and I think the market, everyone is looks forward to opening bell nowadays because typically the market has been in good mood. So opening bells are being looked forward to much more than the closing bell nowadays. I think the question you asked has a broader kind of a tone to it because. If you look at the market today, we are definitely benefiting from global flows, and COVID has been a global phenomenon. Weakening of dollar has been a global phenomenon, and therefore flows into emerging markets has been a global phenomenon. And therefore, on days or weeks, it could be days or weeks when you could see a little bit of a volatility. Also, because valuations are not, I would say, valuations are not cheap. But they are definitely not in the bubble zone, and I'll come to why I think so. Having said that, I think valuations are reaching a level where some bit of volatility is to be expected and is healthy. Nobody wants a linear market. If you want a linear one-way market, it typically leads to a disaster at some point of time. So, at various points of time in any bull market, you will get corrections. You will get some shallow corrections, some deep corrections. So this is part of that. And I think the reasons for that is that our market is now very, very integrated with the global sentiment. As I said, emerging markets have not done well in the last 7-8 years. And because dollar has been strengthening and the US markets have been on a tear, now we are reaching a situation where dollar is showing signs of weakness. There are flows happening in emerging markets, and India being a large part of emerging markets now with the MSCI weightage upgrade, etc. We are getting a decent share of our flows. And also remember, and I'm going one step forward and trying to speculate as to why India is attracting so much of foreign capital. And there are two reasons. One is that we are probably the only country where the lockdown was the most severe, and the second wave is still not happening. So for such a large population and with all the festival season behind us. The second most important reason is, despite the most severe lockdown, our government fortunately did not heed to the request of more fiscal stimulus. So we did not go down the route of the developed countries, which had huge fiscal stimulus, which gave out huge fiscal stimulus because we did not have the room. So that is coming in handy, because although our fiscal deficit is going to go up, it is still not going to be 15-20% of GDP, which is what seems to be the case in US. So our sense is that that the flows will remain healthy, but flows being flows can be volatile and dependent on some of the news flow, like you mentioned, and I would see that as a part of the part of the game, essentially.
Right, right. So you made a couple of very interesting points. Okay, so to recollect and recount, you spoke about the valuation, right? So and I agree. The headline long-term inflation, valuation of Nifty 50 is very close to the long-term average, right? We are talking about 19 and a half times
Right.
P, and at the same time, I believe that the rally has been largely secular. Okay, after the dip, especially, it at least looks secular at the very outset. There is a certain weight and depth to the rally that is happening. But most of this is a result of a trifecta that is working together. One, obviously the valuations are looking decent. So the three things are the earnings and the profitability, right? So we all know that. The listed companies are showing up very good profitability, but now the point here is it is majorly on the back of cost reduction, okay, discretionary cost reduction. At the same time, we all know that there is a huge massive influx of liquidity, but we know that there is foreign money that's coming into India majorly because India has good fundamentals, one, and another supporting point is there isn't an alternative as good as India available immediately to the foreign capital. Okay, that's number two, considering the global interest rate situation. And third is the sentiments that everyone has today. All of us are eyeing for recovery. All of us are hoping for recovery. The news flow is having a positive impact, so people are believing in a recovery. I feel believing in a recovery is the first step towards an actual recovery, right? People got to believe in it, and that's when actual recovery will happen. So now, given these dynamics playing out, we are seeing the markets also reflect an uptick. But one thing that still bothers me is that this uptick is majorly in the bigger companies, right? In the listed space, majorly. Um, we are yet to see key benefits trickle down to the unorganized segment of the economy as well, right? So the question is, if you agree that the unorganized segment is yet to recover or yet to be on the right track for recovery, do you think it will come and bite us in the back sooner or later? Do you think it will drag the economy behind, and behind more than what we would have otherwise expected? And this could be one of the shockers lying on the fence. If we do not pay attention to it immediately, this could really backfire bad. What's your opinion on this?
Yes, I agree. I think the unorganized sector in India, the small businesses, they employ a lot of people. And if they don't do well, even though we are trying to revive manufacturing through the production link incentive scheme, that's a 3 to 5 year process. So, still, to a large extent, the number of people employed in the unorganized sector is going to be far in excess of the organized sector. And therefore, at some point of time, if that part of the market, which has not been doing well since demonetization, number one, number two, GST, and
GST.
now COVID. So there have been three hits to that segment. So far it has not impacted consumption, but my one of the fears or one of the concerns is that at some point of time it will start to hit consumption, or the consumption theme, which we have all been positive on from an Indian perspective. So I think I think the challenge is therefore to try and revive that consumption and revive the income levels of these unorganized sector. And I think the biggest kind of thing which can revive the this particular segment is to also simultaneously have an investment cycle. What India has lacked over the last, I think 12 years now, is that we haven't had a good positive private investment cycle or a government investment, public investment cycle, as well as real estate sector, which is a household investment. So there are investments at three legs: household, private, and public. Um, while public has been, there have been cycles which have been positive. I think private capex has not picked up. Household capex in real estate has not picked up, and these are the two which are now showing signs of revival. So my sense is that we will have a situation where you will have the investment cycle coming to the rescue. And I think that's very important message I wanted to leave here, is because without investment cycle reviving, there is a limit to how much consumption can feed on itself, and therefore it can slow down, especially with the kind of hits which you're talking about to the unorganized sector. But I am beginning to get positive on the investment cycle a little bit, driven by two, three things. One, lower interest rates, which is leading to demand in real estate. Two, the government fiscal deficit is not completely gone out of control, and therefore government still has got some ammunition left for next year to start investing on their own books. And third, which is the most important part, is that private sector or the corporate sector has started to spend again. We are seeing some signs of investments happening in cement. We are seeing, obviously, this production link incentive being a huge game changer in my view, because for the first time, government has put money behind trying to shift manufacturing away from China into India, and trying to encourage scale in manufacturing. One of the things which India has lacked is big scale, large scale manufacturing. And therefore, to encourage large scale manufacturing, encourage production link incentives, and also to set up the entire process to attract investments, I think is very, very critical. So if we get the investment cycle going, the reason why I'm talking so much of investment cycle is, if we get the investment cycle going, then all these concerns which we are talking about of the unorganized sector not doing well, or employment in that unorganized sector taking a hit, or income levels taking a hit, gets taken care of to some extent. And that will be a virtuous cycle, because that can generate employment, that can generate consumption can increase the capacity utilization and continue to require more and more investment. So it's a virtuous cycle. Right now in India, what we have had is only consumption, and no investment. So I think that for it to change is very, very important. And I think it's early days, but the signs are good.
Right, right. I believe it's been long enough that all of us have been talking about consumption cycle, but like you rightly said, consumption can't keep feeding off of itself for a very long time. And the investment climate in India hasn't been really good since a very long time. So what you say, definitely has a lot of merit to it. I can understand where you're coming from and resonate and appreciate the fact that turnaround in the investment cycle could actually kickstart this virtuous cycle that you spoke about, and it would result in a much more sustainable consumer cycle, as a byproduct of a recovered investment cycle. So while we're talking about investments, it brings me to another point, slightly off, but I need to ask this question. Tata Mutual Fund runs one of the um, very good sectoral schemes that there is in the banking and financial space, right? So there's the Tata Banking and Financial Services Fund that has been doing consistently really well. So Tata is among the very few AMCs who seem to be getting the sector right. Okay. So my question is going to be focused on the sector itself. Obviously, as if the economic recovery sustains, We know that financial services in India will be in the first order of recovery, but there are many conflicting pointers in favor of and against the sector itself. So, the public sector banks are raising capital, the economic recovery is in place. We are hopeful of credit offtake, but credit offtake is not quite where, we would like it to be. The banks are also afraid, right? We are in a terrorized climate when it comes to
Right.
lending, right? Banks are really, really afraid of lending, and the NPA situation is not really. So while it is improving, I feel it is, optically it looks good because of the base, but it's not really where we would want it to be. So there are many conflicting points around the banking and financial service space. So basically, I feel it would be great for us, the audience, to hear your views on how should we read into the banking space. What do you think is going right for the banking sector? What's going wrong? What are the risks, and how should one view it?
So I think the sector has gone through one is a very long cycle, and then there is the short cycle. The long cycle started in 2010-11 when we started to enter a bad loan cycle, and I think by 2017-18, RBI, between RBI government and the banks and the IBC, bankruptcy code, new bankruptcy laws, I think they had gotten control of the corporate bad loans. And we saw that in 2019 there was a sharp improvement in the asset quality of the banks, of the corporate banks. And I think somewhere around that time the NBFC crisis started, which gave an opportunity for the large private sector banks to take market share. So that trend still continues. Having said that, I think COVID actually disrupted that long cycle through a short cycle. The short cycle of COVID has lasted only 9-12 months, because when we were in June, we were fearing that the bad loans, because of COVID alone, could be 8 to 10% of the total loan book of the company, of the banks. Instead of that, what we have realized in the last quarter results, and as we interact more and more with the banks, is that the actual stress of COVID is not more than, in a lot of cases, not more than 2 to 4% of the total loans. So it's actually 25% to 50, 75 to 50% lower. The stress, is actual stress is lower than, much lower than the amount which was feared in June. And I think that's a very, very big positive. The market has realized that, and market is actually kind of rewarded some of these banks. My own sense is that we are still not fully recovered in terms of valuations. Some of these banks have still not recovered fully from valuations, as the market is still a little bit worried about whether there will be a second wave, whether the actual non-performing loans are going to be as low as what the banks are saying or not. So I think the market will watch it. But my own sense is that the actual situation is better than what was feared. The valuations, while they have rebounded, they have not rebounded completely. So at the margin, I would say we continue to remain positive on the sector, because that the short cycle of COVID, which could have become a long, drawn-out, bad loan cycle, thankfully and fortunately, is not turning out to be that way. So, and the valuations in a lot of places are still reasonable, barring 2 or 3 banks. I think generally the valuations are reasonable. So we remain positive on the sector. Also, liquidity has been good. And if there is a capex revival, investment revival, credit growth will automatically come back. Consumption revival is happening as we speak. So retail loan growth is bouncing back. But for the corporate loan growth to bounce back, and some of the banks are actually talking about the growth coming back in even the corporate loans, and that's a positive. And I think for banking, nothing works better than a good economy. I mean, for banking sector, the buck stops with the economy. If the economy is bad, however good a bank you might be, you will still take a hit. And if the economy is good, however bad a bank you might be, you will still benefit. However hard you try not to benefit, you will still benefit. So if we are entering a phase where the economy is on the mend and is actually looking up and the investment cycles are looking up, you cannot not be positive on banking.
Right, right. Very well put. So I feel obviously I'm in complete agreement. It made complete sense to me that if you are confident in a broad-based economic recovery, there is no reason to not be confident in the in an enhancement in the banking sector, right? And obviously, like you said, there are a few building blocks and fundamentals that are in place that will help the banking sector, recover much beyond what we are already looking at. So, another pivotal shift in the conversation as I move towards another much talked about topic among investor forums. Again, this is one of those topics that investors love to whisper to each other but not talk out loud about. It is the mid and small cap space. The mid and small cap space has been doing relatively good, okay, surprisingly well. In a way, it wouldn't be wrong to say that the largest of the returns were delivered by the smallest of the stocks, in a way, especially during the last couple of months. So there are a few perspectives to the small and mid cap situation. Okay, uh, in the small cap space, especially. We have noticed even in the past that during shorter term periods, shorter term trailing returns, small caps don't shy away from delivering double digit returns as well. 3-month returns, 6-month returns are going to look fantastic. Like 40%, 50% delivery is also, not a surprise. But as we move towards a longer trailing sort of a return, the returns don't look as amazing. The CAGR doesn't look as beautiful as most other large cap actively managed funds are. So the first half of the question is around the sustainability of the performance of small and mid caps, and the second half of the question is, what do you think is contributing to the uptick in small and mid caps, and what is your your outlook on this segment? See, we know there is an influx of liquidity, and mid caps slightly have benefited from its inclusion in the MSCI indices. We also know retails are trying to speculate in the segment. But do you think these are reasons big enough to justify the way mid caps and small caps are doing right now? So to simplify, two parts of the question. Okay, one, what is your view on the mid and small cap segment right now? Two, what is your outlook on the sustainability of the performance?
Right. So if you look at the mid cap as a segment, and I'll come to small cap later, because whatever I say about mid cap is will be more true for small cap. So I'll just use mid cap as a sample set, and the most of the deductions are will be true for small cap also. So first, look at the valuations of mid cap. So if I look at the forward multiple for NSE mid cap 100 index and compare it with Nifty 50, today it will be trading at a premium of say 5 or 10%. In the history, if I go back and look at the 10-year history, typically it has traded at about 10% premium. So we are at an average level. That's point number one. So we are not we are in a neutral zone. We are not obscenely valued. We are not in a bubble zone. When we reach a bubble or a euphoria kind of period is something like what happened in 2017 or 2014. So just to give you some reference point, in 2017, NSE Midcap 100 was trading at a 70% premium to Nifty 50. Now that's called a bubble, that's called a euphoria, that's called irrational exuberance. Today at a 5-10%, or I would say at absolute parity to Nifty 50, in fact, I would say, there is no, for us, it's a neutral zone. When we are going out there and choosing our investment ideas or selecting or discussing, we are not really bothered today by the headline mid-cap valuations. Yes, they are not cheap, but they are not. It's not a bubble in our view. And as when it comes to small cap, it is at a discount. So obviously there's not even a discussion of premium to a large cap. That's point number one, and which is why I think the interest in mid cap and small cap would remain purely from a headline point of view. Number two, and more importantly, is that today, when we look at the economy, there are multiple small themes which are emerging post-COVID, whether it is digitization or electronic manufacturing as a theme, or e-commerce marketplaces, some of which are listed. The large ones are not, but some of the small ones are listed. Or you look at things like pharma API manufacturers, which is the big which has been big beneficiaries of COVID, and also the PLI scheme. So the point I am trying to highlight by pointing out these sectors is that most of these sectors are represented much better in the mid and small cap space, because these are niche opportunities, and these niche opportunities are emerging out of the situation in which the world finds itself in, and India finds itself in. And naturally, these will be either mid or small caps. So that's the fundamental bottom up way of looking at it. So I gave you the top down point of view in terms of valuation. The bottom up point of view is that we are finding more new emerging opportunities and new emerging themes in mid and small cap. Similarly, if investment cycle picks up, we spoke about it in the beginning, in the first question, I think. If the investment cycle picks up, and manufacturing revival happens, again, mid and small caps is where bulk of the listed manufacturing and infrastructure plays are. And over a period of last 10 years, what has happened is large caps have been dominated by banking, IT, pharma, consumer, broadly speaking. And infra missed out, even pharma has missed out for that, to that extent. And manufacturing as a segment has missed out, essentially. It is like India is a service-based economy. So the large caps are dominated by services, including banking, and not so much by manufacturing and infrastructure. And therefore, when you talk about mid and small cap, which is that is where you find most of the manufacturing and infrastructure plays. So that's another segment which, if it starts to do well, automatically that's a mid and small cap space. By definition, it's a mid and small cap space. So what I'm trying to say is that there is a top-down valuation support, and there is a bottom-up kind of emerging themes which are more present in mid and small cap today, and that makes it an interesting kind of a mixture of top-down and bottom-up drivers of mid and small cap going forward.
I feel towards the end, you summed it up really well. Top bottom perspective is going to support the perceived future of mid and small caps as an emerging trend, and the bottom up approach just helps us identify much better strength and resilience within the particular segment. So as we move towards the fag end of the session, one last thing that I wanted your views on, and I'm sure our viewers would also be interested in knowing, how do you read on the situation wherein India is receiving most of the global flows, right? We spoke about it briefly during the beginning of the session, but couldn't dig in deeper. But as we move towards the end, your commentary on the shift of capital from developed economies to emerging economies, especially India. What are your thoughts? What is causing this? For how long is this money going to stay in? And what are the prospects for those who believe in the India story?
Yeah, I think it's getting caused by two, three things. One, that for the emerging markets, COVID has been much less of a disruptor than the developed markets. That's the big picture point. So if you look at today, the worst infections rates and the worst fiscal deficit situation has been in developed markets. Whether you talk about UK, Europe, I mean, the trend is very, very clear that somehow the virus has affected the developed countries' population and the government's balance sheet much more than the developing countries. It's quite stark. I mean, it's quite it's quite a correlation actually. That the COVID infection rate has been highly correlated to the per capita income of that country, except China, of course. So that is number one, which leads to high fiscal deficit in the developed countries, specifically US, which puts a pressure on the dollar, and therefore flows away from the developed markets to the emerging markets. So that's a big picture. That's a big theme which is playing out, and it's not only true for India but for all emerging markets. Now, within emerging markets, how does India stack up? Obviously, the infection rate initially was very high, but the fiscal deficit has not gone out of control. It has gone up, obviously, but it has not gone out of control. Secondly, in India, there's a large part of the listed market like IT, pharma, telecom, which actually has benefited from COVID. So we are not a single dimensional market that we have only commodities or we have only consumption, we have only exports. Uh, we we have a huge variety which has helped our markets, and I think that is what is helping us get the flows. Again, like I told about the mid cap valuations, here I would like to give one data point that if you look at Nifty 50 valuation versus the MSCI emerging markets, in terms of the valuation, pure valuation, we have generally traded at a 40 to 50% premium to the other emerging markets over a 10-year history. I'm talking about the P ratio. We generally traded at 40 to 50% premium because we have a higher ROE, we have better quality management, we have more consumption plays, domestic economy plays. Now, today, if I look at the valuation of Nifty versus MSCI emerging markets, we look at a number which is somewhere in the middle, which is 45, 46, 47%. Again, not alarming, not alarming. It's definitely at an average level of last 10 years. So the point I'm trying to make is that whatever has happened, whatever rally you have happened in India, or we have seen in India, is something which has not expanded India's premium over other emerging markets. It is merely tracking the other emerging markets. So I don't see anything which is different from what's happened in other emerging markets. And now our sense is that we've already seen the profit estimates moving up. There was a sharp cut because of COVID, and now the profit estimates are moving up. And we think that the profit estimates for India will continue to move up over the next 3 to 6 months, given that banking sector is doing better, investment cycle might recover. So I think the P ratio or the P premium over other emerging markets, even if the market rallies, will not go up too much. So our sense is that if the dollar weakness trend continues, for which the chances are pretty high, and emerging market flows continue, India will continue to get its fair share of those flows because we as a country are showing significant resilience. Our fiscal deficit, while high, is not completely broken or not completely gone out of control. And lastly, the earnings are looking up. The profit estimates for corporate sector is looking up, partly because of cost cuts, like you had mentioned, and partly also because the organized sector has managed to cope up better with COVID, and therefore they're also gaining market share from the unorganized sector.
Right, right. Very well put. So, Rahul, this brings us towards the end of our conversation, but I would request you to answer a couple of questions that our audience has been have been putting up. So, there's a huge flurry of comments. Okay, so there are quite a number of questions. Let me just pick the top three questions, and it would be great if you could respond to it. So there's one question that goes by: the markets continue to be influenced by big players. Uh, Given how markets are designed to always reward the big, what has made the polarization so visible today? So I believe this is asking for your comments on whether there's a polarization. So there is a visible polarization. So what are your views on Nifty 15 and the rest of the Nifty? Or your view on the polarization that we're seeing?
Yes, polarization has happened because I think initially, because of COVID and also because of GST and demonetization and so many other developments which have been building up over 3 years. So it's not just COVID. That the large banks have become larger, the large companies have become larger, the market leaders have become larger because they have gained market share from these smaller players. But we have reached a point where all this has happened already over last 3 years. And we have also reached a point where if the broad economic recovery happens, it gives smaller players and the middle-sized players also a chance to participate in growth. What we have seen in the last 3 years is the economic slightly, decelerating. Every time we started with 7%, and if you recall, in the December quarter, even before COVID hit, our GDP growth rate, if I'm not mistaken, was 4%. So from 7, we had come down to 4%. So when 7 comes down to 4%, even before COVID, typically the larger companies will be able to cope better. And then COVID happened, and that trend has accelerated. But what COVID has done is to obviously give chances for the new sectors, new themes to emerge, like what I was telling just a while back, that some of these new sectors, new themes, and production link incentive, manufacturing revival, investment revival gives an opportunity for the mid-sized companies to also participate as much as the large-sized players. Remember that most important thing, just remember that if there is a broad economic recovery, like I was talking about banks and NBFCs, the middle size and the small size companies benefit the most, because the reverse is true. When 7% GDP growth rate became 4%, the large caps benefited. When 4 goes to 6, 7, it is the mid and small cap which will benefit slightly more. So you have to remember that, and remember that the 2018 till now, mid cap valuations versus large cap valuations, they have not gone out of control. Small caps are at a discount. So all this makes me slightly more optimistic that the polarization which you have seen will not continue significantly in 2021.
Right. Uh, so there is one sector-specific query, which is inviting your views on the technology and IT sector. So if you could just share a couple of pointers that one must look out for in these sectors.
Yeah, it's a very steady sector. We like the sector. I think the biggest thing in favor of the sector is that today, with the demand on each old economy organization to become more digital, there is more and more outsourcing going to happen. There is more and more stuff which is going to move on the cloud and outsourced. And some of these companies, the large IT companies in India, they have done an excellent work over the last 3-4 years building their capabilities on cloud and on the digital side. So they have been on the investment phase last 3-4 years, and all that is bearing fruit. In fact, yesterday, if you had seen the news, the two largest companies in India have declared very, very large size deals of outsourcing. So what is happening is that IT outsourcing as a concept, and cloud as a concept, and digital transformation as a concept has got accelerated by at least 12 to 24 months by various estimates. So traditionally, if a corporate would have taken 24 months to do something in terms of digital and cloud, it is happening immediately. It is happening in 6 months. So we remain positive. The valuations, obviously, the sector has rallied, and the valuations have become little expensive. But if you go back in history and look at, let's say, 8-9 years back, IT sector and consumer sector used to trade at same valuations. Today, consumer sector has gone to, I think anywhere between 50 to 60% premium to the IT sector. So I think if IT sector delivers on the numbers, the balance sheets are so great. The management quality is superb in all these companies. They pay huge dividends. They have the policy of returning cash to shareholders. So as a sector, I think it's in a sweet spot for the next 12 to 24 months.
Yep, sounds great, Rahul. There's this last one question, and I just have to ask it because it's a very pertinent question that most investors are writing to us as well about. So the question is pretty small. Is now a good time to book profits?
It depends on your personal situation. I know you will hate to hear a question answer which starts with "it depends," but that's the reality. If you are an average investor with with a 40-50% allocation in equity or 60%, I would not advise booking profits. But if you are someone with a 90-100% equity allocation, I think some de-risking, some reducing the risk is called for, which means that I would not recommend booking profits and moving to a, let's say, a liquid fund or arbitrage fund. But I would definitely say that you should consider moving. If you are currently allocated as high as 90-100% in equities, then you should book some profits and move into category called balanced advantage funds, because balanced advantage funds will manage the risk of overvaluation for you. So for example, just talking about that for a minute, in our balanced advantage fund, we have equity allocation which ranges between 40 to 80%. So
Right.
right now we are at the lower end because of the higher valuation. So we are at 50%. And if the market rallies further, we'll go down to 40%. If the market corrects, we can go back up to 60-70%. So last year we were at 40% in March when correction happened. We went up to 75% and now back to 50%. So I would think that, so the answer depends. If you are 100% in equities, yes, I think you should move 30, 35, 40% of that into balanced advantage funds. But if you are 50% into equity, I see no reason to, I think you should then, on every correction, deploy the remaining into equities.
Right. So the response to profit booking, guys, like we always say in every wealth cast, it has to do a lot with your asset allocation and your risk profile. So and I was almost expecting this answer. We have been repeatedly sharing it with our viewers as well as our investors. That the key to making money in the market for an average retail investor, unless savvy, is to stick to asset allocation, stick to discipline, and stick to the plan, guys. I mean, there's no need to react to every piece of information and news that comes along the way. And I feel Rahul also made it very clear that unless you are hogging on to too much equity and it is required from a de-risking standpoint, unless that is the situation, there is no need to essentially rebalance your portfolio, right? And obviously I feel most of us do not like responses that starts with depends, but I feel this was the most accurate answer that could be to the question that was asked. So Rahul, we move towards the end of the session. I feel that this has been a highly productive conversation, a wonderful conversation, very interesting pointers that you have shared with all of our viewers. Really thank you to take out time and be our guest on the Fisdom Wealthcast. We look forward to hosting you soon again on yet another episode of Wealthcast someday soon. Yeah. Thanks a lot for being on the show, Rahul.
Thank you, Nirav. Thank you for hosting me. And once again, I thank all the listeners for patiently listening, and wish you all a very happy and safe 2021. Thank you.
Thank you, Rahul. So, guys, this was Rahul Singh, the CIO-Equities of Tata Mutual Fund. So, Rahul looks after a lot many successful mutual funds that Tata Mutual Funds is running, and I feel it was all pretty evident by the words of wisdom that he shared with each one of us. So there were a few pertinent points that we spoke about, discussed. Primarily, we spoke about the valuation scenario in the capital markets today. Rahul was of the opinion that, at least that's how I recollected, was that while we are very close to the long-term averages, it is not yet entered a bubble zone. We are still in a very comfortable and fair valuation zone. That's point number one. Point number two, as the economy recovers, there is some merit in considering, nibbling onto mid and small cap funds. That is obviously if it is in line with your risk appetite, your asset recommended asset allocation, and your financial plan altogether. So that's the next point that we spoke about. Apart from that, we spoke about how the world is investing in India because of the very strong fundamentals and the promise that India holds, and what it has to offer to global money. So, these were a few things that we spoke about. Obviously, there are a number of things like how we are expecting the capital investment cycle to spur a virtuous cycle. We had this entire conversation of how it will lead to a much more sustained consumption cycle. We also spoke about the banking sector in detail as to how should we read onto it, and the indication was clear that there is some upside that can be expected within the segment itself, and all of this riding on the great Indian economic recovery story. All right. So the bottom line, guys, the world is investing in India. The world believes in the Indian market's recovery. Most of our retail investors are believing in the great Indian recovery story. The question is, are you being invested while the Indian economy recovers? So I know there are many questions that we couldn't take up. So, whatever questions that remained unanswered, you could, guys, you can write to us at research@fisdom.com, and we will try and help you with any sort of query or doubt that you may have pertaining to investments or portfolios. So, meanwhile, guys, like I always say, the more you learn, the more you'll earn, and it's always a great thing to share. So let's begin with sharing this video. So don't forget to share this video with all your loved ones and help them to learn and earn more. At the same time, subscribe to the channel for more such updates. Last but not the least, like the video, and very soon we'll be back with yet another interesting episode of the Fisdom Wealthcast with yet another interesting guest. Meanwhile, stay invested, keep earning, have a great New Year, have a great Christmas. So stay invested, guys. Thank you.